Okay, so this is question 1 of paper 2. First adjustment, net realizable value of inventory is $23,500. If you compare this with your cost, the cost that is written in your books is actually higher. You're supposed to value inventory at the lower of cost or net realizable value. So we always take the lower amount. In this case, $23,500 is the lower amount. So what we need to do is bring down this amount to $23,500, which means we have to minus away $823 so that it becomes $23,500. And this amount is what we call impairment loss on inventory. So we have to create an account called impairment loss on inventory, $823. The next one, annual insurance is $14,000. You compare this with the insurance that is in your books, is actually less. So what you need to do is make this $14,000, which means we have to plus another $777 more to get the annual insurance. Okay, because we did not record this was incurred, but we didn't record, we didn't pay. So this is what we call accrued insurance of $777. The next one, $876 worth of stationery was meant for May. We are now in April. If it's meant for May, that means it's meant for the next financial year. So out of $2,876, $876 has to be taken out. Okay, so this means that we have paid for it, but we have not used it yet. And this is what we call a prepaid stationery expense. And this is $876. Okay, business had not received $800 in commission earned for the month of January, which is this financial year. So we have to record $800. So if you look here, there is no commission income account. So you have to create a commission income of $876 because you have earned it but you have not received it. This is what we call a commission income receivable of $876. Okay, the next one, motor vehicles depreciated 10% using reducing balance method. So when you use the reducing balance method, you need to minus away your accumulated depreciation. So take your cost of $65,000 minus away $7,800 and times 10%, and this will give you $5,720. So there are two adjustments when it comes to depreciation. Number one, you need to create a depreciation expense account. This is for the motor vehicle of $5,720. You need to go to your accumulated depreciation for motor vehicles and plus 5,720. Next one, fixtures and fittings is 5% on cost. So if it's on cost, it's more straightforward. All you have to do is take the cost price of your fixtures and fittings, which is $17,980 times 5%, and this will give you $899. So once again, same thing, you create a depreciation expense account. This is for your fixtures and fittings of $899, and you go to your accumulated depreciation, $899. Okay, next one, $900 owing by credit customer confirmed to be written off. So two accounts are affected. When it's confirmed, what you have to do is go to your trade receivable, minus away 900, go to your allowance, minus away 900. Once it's confirmed, these two accounts are affected. At the end of the year, when you do a review, the company feels that $1,200 may not be able to pay up. So you need to set aside $1,200 in your allowance account. So if you look at your allowance for impairment or trade receivable, you currently have $90. But this needs to be $1,200, which means you need to add $1,110 so that it becomes $1,200. Alright? This amount that you have added is also what we call an impairment loss. Impairment loss on trade receivables, 1110. Okay, the next part, interest on loan is 3% per annum. So the loan was taken on 1st January. So 3% per annum, what you do, you take 3%. Your loan amount in this case is $50,000. So you times $50,000. However, if you look, you only took it on 1st January. It is now 30th April. So you have only used this loan for 4 months. So you have to prorate it. So you only pay interest for 4 months. Okay? Check if there's an interest on loan expense account. There isn't, so you have to create an account called interest on loan, and this is $500. So you have incurred but not recorded, not paid. Alright, so you need to create an account called accrued interest on loan, $500. Alright, last adjustment, 10% of the loan is repayable on 30th June 2019. So 10% of the loan is $50,000. Okay, so this means that 10% belongs to current liability because it is due within less than 1 year. Alright, and we call this current portion of long-term borrowings. Okay, so this 5,000, it's current portion of long-term borrowing. So over here, you minus away 5,000. So 45,000 is your long-term borrowings because this is still due, alright, more than 1 year. However, that $5,000 will be what we call current portion of your long-term borrowing, and this will be under CL.